Welcome back, everyone. Today on the Joseph Carlson Show, as companies like Google, major companies today, trade off at the beginning of September, as they often do, we have Google here down 2.44%. The company is now at a market cap of around $2.5 trillion, but we have reason to believe that Google could be worth much more in the very near future. In fact, just around a week ago, CNBC shared this graphic, this breakdown of all the various businesses of Google. We know that Google is not just doing one thing, they have their hands in many different things, and those things are worth different amounts of money. CNBC mapped out what the average analyst estimate is for all of these various businesses, each on a business level. And the estimates from the analysts are much higher in aggregate than where Google trades today. So we'll be going through each of these businesses from Google, the average analyst estimates for the business, and breaking down what the true value is today to try to determine what Google's actually worth. Now, of course, we have a lot of other news to get to in this episode. For example, the whole stock market's falling. This is common in September. We see it in the data. Why is September such a bad month for stocks? Well, we can talk about it, especially what investors should do in September. We have people like Jeremy Siegel that thinks that we should remain optimistic, even if we have a rough start to this month. And then we also have news that Kraft Heinz is breaking up, and this is bumming out Warren Buffett. He's spoken on the subject, saying that he's deeply disappointed in the separation. We'll be talking about that as well. So like always, we have a ton to get to in this episode, and we start things off with the breakdown of Google. Now, before we jump into that, just a quick mention, it's the beginning of the month, which means if you join the Patreon today, you'll have the entire month as a free trial. So now's the time, try it out. After the free trial, it's only $10 a month, and I think you'll love it. We have a lot of people that love it. We are past 10,000 members now, and it's growing quickly, so try it out if you haven't. Now let's go ahead and talk a little bit about Google here. First of all, Google is a main position in my portfolio. In fact, it's steadily grown as a position over time. And in the passive income portfolio, in particular, Google's a rather new position. It's around $68,000 in total value, with $10,000 of it being gains, even after today's losses. When we look at it in the story fund, I can also bring that up and show you real quick. I have more Google in this portfolio as well. The story fund is my smaller, more concentrated, more aggressive, growth-focused portfolio. And Google has been here for quite a while. So the gains are far more substantial in this one. With a total position size of 45,000, 21,000 of that's gains. So this one has done a lot better. I've just owned it for longer. I bought it at really good times, and Google has helped this portfolio outperform. Now, when we're looking at Google and the valuation of the company, it's important to address specific concerns and the trading patterns of this stock. Google has been underperforming its peers for quite some time. In fact, even today, the valuation multiples are far below Meta. They're below Microsoft. They're below Apple. They're below virtually every other big tech company around it. Google's by far the cheapest one. And part of the reason is because of the concerns that have centered around this company. In particular, the transformation with AI information gathering. And this was the big problem with Google. The fact that there's new ways to gather information. Many people have made huge claims that this is going to dramatically challenge Google, that it's a big disruptive risk, that it's changing the ways that people interact with Google search, and it might lower the margins of the company or make the company worse overall. But what we've seen over time, and what I've become increasingly convinced of, is that it's not being disrupted. Google search is simply not being disrupted in the way that we thought it might be. In fact, the data that's come in quarter after quarter after quarter after quarter show that Google search is actually growing. Google's also done a very good job adapting with the times. With the threat of ChatGPT and Grok and many other AI searches, Google implemented something called AI mode. AI mode is the benefits of both worlds. It has LLM technology as well as relevant search information. It's always up to date. It works almost instantly. It's a really new technology in Google search, and users love it. AI mode is being used everywhere now. And on top of that, Google has the more dedicated Gemini for longer, more complex conversations. So Google has adapted to this new challenge, to this new disruptive threat. They showed that a technology that could have potentially disrupted them actually grew their market share and sped up the growth of Google search. Now, with that challenge behind us, and some people don't think it's behind us, they still think Google's going to be disrupted by AI, but there's fewer and fewer of those people. Now most people realize that artificial intelligence is going to benefit Google overall, and that the search business is not becoming disrupted like people thought. It's just evolving over time. Now, with that said, where does that leave us? What is Google stock actually worth if we assume no major disruptions to Google search? Well, that's a more complex question because we look at Google and this company has many various business lines. When you break it down by revenue, you have Google search, you have YouTube ads, And this is a little bit complicated because YouTube ads does not include YouTube Premium, which they have over 120 million premium subscribers. So YouTube also is bigger than just this portion shows. Then you have Google Network. You have subscription, which includes things like Google One and YouTube Premium. You have Google Cloud, which is a monster of a business. Then you have other bets, which could be renamed Waymo, because the most significant other bet by now, by far, is Waymo. When we look at Google in their total value, it's already at a decent valuation. But when we break this up by different businesses that Google owns, if you're looking at it as Alphabet, a conglomerate of unified businesses, it's even cheaper. And that's where we get into this chart here, this graphic showing all the various businesses of Google. We have Search, DeepMind, and TPU. We have Google Cloud, YouTube, Waymo, and Network. We have all these various businesses with their numbers underneath of what the analysts think they're worth. So they've averaged out all the analysts, they've attached the numbers, and that is a combined valuation of Google. When we look at this business by business, we can just take a look at what the analysts think of the business today. For example, with Google Search alone, just the search business, they have a price tag of $1.25 trillion. So the analysts believe that search alone justifies half the market cap of Google today. Then we get into DeepMind and TPU. Now, this is an interesting way to break it up, but the analysts believe that this part of Google, which used to be a cost center, pouring money into artificial intelligence and their models, now it's no longer a cost center. DeepMind is making a fortune. They're licensing all this technology. You can see the tokens being used for all these different models like Gemini being used more and more. Google has a 1,000 different ways to monetize this. So DeepMind is a huge part of Google. It's a massive part. They have some of the leading models with distribution for it. And then you have TPUs, which are Google's proprietary chips that they developed to help manage all of this, to make it so they're not so reliant on NVIDIA. When you combine both of those together, the analysts are saying that it's worth almost $900 billion, $897 billion in terms of the average analyst estimates. Then we add in Google Cloud. They say that this is worth $572 billion currently. We add in YouTube. YouTube, they're estimating to be worth $446 billion. Then we add in Waymo. With Waymo, they're giving it a valuation of $173 billion. And then the analysts believe that the network business is worth $138 billion. Now, what does this look like if we add together all these numbers and see what it amounts to? Well, I went ahead and did that for you. We have all the various estimates right here from the analysts, all the different businesses, and it adds to $3.476 trillion. So if you take all the average analyst estimates, you combine them together, they overall believe that the company is being undervalued by a full $1 trillion. And that means that if you were to add that $1 trillion to the market cap, that would be a 40% increase over today's price. That's what the analysts believe. Now we're going to take a look at what I believe. I believe we can do even better than the average analyst. And we start off with Google Search. This is where the analysts had it at $1.25 trillion. And this is going to be one that I don't disagree with. So I'm going to copy in the same number here. I think that you could move it up or down a little bit, but when you look at the numbers, this is pretty straightforward. Google Search is massive. It does make up around half of the total revenue of Google, but also more than the operating income because it's so profitable. Then we have DeepMind and TPU. This is another category where I'm going to agree with the analyst. It's very clear that Google has a massively valuable property here with all their Gemini models and their TPUs. They've been able to outcompete and gain new clients because of their TPUs, their processing power, the lower cost of running all their models, while still being profitable for Google. So they have a lot of ways to monetize this. For this one, I'm just going to keep the analyst estimates. Then we get to Google Cloud. This is one where they have it at $572 billion. And I think this is a low estimate. Now, having a business in and of itself at this scale, growing this quickly, is already a big win. Even if the margins don't look good, even if it's not profitable, having a business grow this quickly is a huge thing in and of itself. But at the same time it's growing that quickly, the operating margins are also ticking up very quickly. So this is growing super fast, but it's also now at a 20.7% operating margin, which is just incredible. And this is not the ceiling. I believe that's going to happen over the next 5 years. And that's why I'm going to put Google Cloud as worth $750 billion today. So I believe there's even more upside with Google Cloud. Now, next we get to YouTube. The average analyst estimate for YouTube was $446 billion. And I believe that's a little low. What I would give as a comparison here is Netflix. Netflix is a company that I'm incredibly bullish on. I think it has an incredible fundamentals. It has a huge total addressable market. It's going to continue growing, gaining subscribers, having operating leverage. Being in digital media is one of the best categories that you can be in. So this is a company that I think is incredibly well positioned for the future. I think it's appropriately valued today. And Netflix currently trades at a $513 billion market cap. So around $60 billion more than what YouTube's currently at. They think that Netflix is worth that much more than YouTube today. Well, there's a couple different things you could highlight here. First of all, Netflix likely has better profitability and cost structure than YouTube. YouTube has to pay their ad revenue, 50% of it, to the creators. So anytime a video makes more views, the creators make more money, it scales indefinitely that way. Netflix doesn't have that issue. They pay for their content upfront once, and then no matter how much money they make from it, they keep all the profits. But while Netflix is more profitable and has better operating leverage than YouTube, YouTube is bigger. YouTube is gaining more market share. When we look at the data here, we can see the market share of all these streaming services over time. And the only one out of this list that continues to gain like a compounding machine year after year after year is that one on the very bottom. That black line on the bottom, that is YouTube. You can see it go from 8% to 9% market share, to 10%, to 11%, to 12%, to 13%. While almost having no seasonality, not giving up market share, there's almost no months that are really bad for YouTube. The other streaming services are highly seasonal. They have a little bit of cyclicality. They give up market share, they gain it back. And even Netflix, as dominant as it is and as good of cost structure as it has not been growing a market share as fast as YouTube. YouTube is the only standout one here that is really destroying everyone else. YouTube is something that people are just watching more and more. There's more high quality content, and now they're getting into sports rights as well. So when I look at YouTube, I have every reason to believe that overall it should be comped to Netflix. And I believe I could put a valuation today of $510 billion. Now, of course, we have Waymo. We don't want to leave that out. The analysts have $173 billion for Waymo. So the valuation of Waymo at 173 is pretty good. It shows that Waymo is actually a big part of Google now. It's actually meaningful. It's showing up on earnings calls. Even though it's not really accretive to the company, it's not profitable, it's not generating a ton of revenue, Waymo's kind of proving a path today. It's showing that it's successful. And again, I believe that this estimate is low. When we look at the best comparison you can come up with today, it's likely Tesla. Tesla's a company that trades off the promise of a robotaxi network. And even though Tesla hasn't succeeded in having a robotaxi network without a driver or an employee in the vehicle at all times, it's still kind of in this testing beta phase. The company's trading at $1 trillion market cap today. Most of that, in fact, I'd say around half of that, is only justified by their promises of a robotaxi network. So you have around $500 billion out of $1 trillion that's just based on the robotaxi network, at least. Because the humanoid robot stuff is way out in the future. The thing that's right around the corner for Tesla is the robotaxi network. So there's a bit of a disconnect here. Tesla stock is trading at extremely high valuations on the promises of doing mostly what Waymo's already accomplished, which is having a successful proven robotaxi network that is rapidly expanding across the globe. When we look at Waymo, however, it's not really being factored into Google stock today at all. Investors are getting no credit for it, but even the analyst estimates are rather low. If Tesla's trading at the valuation it is today based off of that expectation, I think that Waymo should be trading closer to $300 billion. I think that's what it's worth today. Like, you look at the robotaxi network, the success they've had. They've done 10 million rides. The data is very public. It's incredibly safe. They don't have to have employees in the passenger seats. They're accomplishing this. Waymo's actually doing it ahead of everyone else. When I look at Waymo, I'm going to give it a valuation of $250. I think that's appropriate, even conservative for what it really is worth today. And then finally, we get to Network, which they have an estimate of $138 billion. For that one, I'm just going to use their estimate. When I get done with mine, it's closer to $3.8 trillion. So I'm even above where the analyst estimates are. At 3.47, I'm at 3.8. From where Google stock sits today at 2.46 trillion to the 3.8 trillion, that is a 52% increase. So there's my thoughts on the subject. I think that Google's currently over $1 trillion undervalued today, and I think it's going to go up to those valuations over time. It'll just take time for the bearish sentiment, the overall troubled Google, to fade away, for it to get better treatment in the market, better sentiment, which typically happens quarter after quarter. And I think it's going to happen in this case. We'll just have to be patient and wait. Now, moving on, we get to some news here. We have, first of all, the news that September is usually just a bad month in the market. So I don't want to start things off with a big bummer, but we have the opening day of September and it's terrible. Stocks are down like crazy. You can look at your favorite stocks. Many of them are down 3 or 4%. And you might ask why? And that's a question that everybody tries to answer, but there's just no good explanation. There's psychological factors that people have tried to point to try to explain why September is such a bad month. But overall, people don't really know. We just know that it's typically a bad month. Take a look at this chart. The S&P 500 average monthly return since 1928. Most of the time, it's great. September's the one month that on average is minus 1%. It's almost incredible. It's incredibly specific and it's incredibly consistent. Isn't that just interesting? There's 1 month out of the year where the market just does terrible every single year. At this point, it's like a self-fulfilling prophecy. They believe the psychological aspect is part of it. People expect September to be bad. They talk about September being bad, and therefore it self-fulfills and makes it bad. There's other thoughts you can point to, like tax planning. There's September quarterly tax payments due on September 15th, so that can affect businesses as well. But overall, we don't really know. We just have the data. Now, one individual that says to remain optimistic, even though we're in September, is Jeremy Siegel.
Historically, really the worst month of the year. Listen, certainly we could have a pullback. I mean, I still think the bull trends are intact. I know you guys mentioned the Wall Street Journal article this morning about all-time high, so I took it out and read it, and it said, oh, yeah, it's all-time highs relative to sales. Well, I thought we, value stocks on earnings, not sales. And
right.
We're way, below any all-time high in terms of earnings. Not that it's not an expensive market, but once you take out, and even that article admitted, once you take out the Mag 7, we're only, slightly above a longer-term median. So
he points out a couple really important things there. First of all, the people saying that the market's super expensive, like this Wall Street Journal article that they're referencing, points out that it's based on price to sales, which is the net revenue of the company. You're dividing that by the market cap to get the price to sales. And in that case, it's not a profitability metric. It's a revenue proxy, but it's not a profitability metric. Price to earnings is a profitability metric. So when you're looking at PE ratios, that's typically what we've used to determine whether or not the stock market is expensive. We look at the price of the stock market compared to its earnings. Now we're doing that with sales because it sounds more dramatic. When you compare the stock market to the price of sales, it looks more expensive than the PE ratio. And the reason why is simple. Over time, companies are becoming higher margin. We have a lot better companies, more profitable ones that have higher margins leading this stock market. So we have this combination of companies that are trading at higher price to sales, but lower PE ratios.
We mock people when they look at sales. We say that's not the real number. You're right. If we're looking at earnings, that seems like the much more important number to bear out.
And the biggest companies you're talking about, the Mag 7 are the richest in terms of price to sales probably too, because of all the potential.
Now there is a solid use case for price to sales. It does become useful when a company's not focused on profits. So if you have a company that's in a transformation, it's exercising operating leverage, it's going for land grab, they're solely focused on revenue, then of course that company should be priced on price to sales, not profitability. Once a company becomes more profitable, more mature, then you move on to price to earnings. But overall, when you're looking at markets and the overall price of a market, it should probably be based on earnings, not sales.
Because the margins of those companies are so high. Margins of digital tech companies have always been the highest. So if they're predominant, you're going to get a result such as this. And I think that's built into tech. Tech has very, very high margins because of the way accounting goes and the way globalization and how you can replicate at virtually no cost. All you need is those customers to come. So it's a very different sort of a thing than looking back at a steel company or an auto company. And to put them all together, I think gives a misleading look at the market.
We have the best companies in the world growing quickly. They're incredibly profitable. They have robust balance sheets. And even looking at historical terms, the market's not overly expensive today. The bears have simply just lost. They've lost this battle. They don't have a solid bear case. And I believe there's a very good chance that the selling in September is short-lived. Now, finally, we get to the news that Kraft Heinz is breaking up. They're splitting up their company. And Warren Buffett, who's a major shareholder in Kraft Heinz, in fact, the largest shareholder, is not happy about it. When we look at the way that they're doing this, Warren Buffett right now, Berkshire, is a 27.5% stakeholder in the company. Warren Buffett is the one that masterminded the combination of these two companies 10 years ago. So Warren Buffett's not happy about this. After he expressed his discontent, the stock fell another 5%. Buffett told CNBC's Becky Quick on Tuesday that the merger didn't turn out to be a brilliant idea, but he does not think that taking the company apart will fix its problems. They're also not happy about the fact that Kraft Heinz didn't even ask their opinion. They own over a quarter of the company, almost a third, and Kraft Heinz management did this without even asking their opinion, without asking for a shareholder vote or any type of input. Now, this is going to be one of the cases where I actually disagree with Buffett. I think that this separation is likely good for Kraft Heinz, and it also shows why you shouldn't follow Buffett into every single trade. A lot of people get very excited when Berkshire buys any company, but there's a couple of them that have not done great. Kraft Heinz is one of them that over the past decade, it just really has not done well. It's down 63%. It's been a massive loser in the portfolio, and that's driven largely by no growth. That's the biggest problem this company faces. Kraft Heinz has been the same company at the same size, at the same saturation and scale for a decade. And you've seen the growth trajectory here. It's nowhere. In fact, if you adjust this for inflation, Kraft Heinz is losing market share and shrinking over time. And I believe the management has good reason to want to split up the company. Having a company do so much, have this massive conglomerate, control so many different properties, is relatively complex. It makes the logistics and the marketing and all the efforts behind it very difficult. If they split it up into two different portions, which they're doing, and they're making one portion a slower growing portion, the other portion, the actual growing part of the company, a separate company, that makes it so that you can have more streamlined marketing, so that you can actually make acquisitions that move the needle for these different businesses. And it allows investors to pick and choose which company they want to invest in, a non-growing mature portion or a faster growing younger portion. Investors can now choose. So even though I don't think that this fixes the problems, I do think it's a different approach than what's been happening over the past decade that hasn't been working. But in any case, management probably should have got Warren Buffett's approval, seeing as he's such a big shareholder. That's going to be it for this episode. Hope you enjoyed. See you in the next one.